Good morning or good afternoon, depending on what side of the country you're joining us from. Thank you all for hopping in for this incredible conversation we're going to have today. The ALM Playbook, Optimize, Manage, and Grow. So with that, I want to thank you all for being here. I'm Charlie McQueen, President of McQueen Financial. I'm thrilled to be here with two incredible leaders of our organization. On the next slide, you're going to see Heather Shepperly. Heather runs our analytics department. Really excited to have Heather joining us here. She has all of our data and modeling and make sure all the reports get on a timely basis. So Heather, I appreciate everything you and thank you for joining us today. All right, and we skipped him, but we'll go back one for fun. Mr. Matthews, Jim Matthews, we refer to him as the professor. We're thrilled to have the professor here, one of our senior advisors. Definitely has just a great wealth of knowledge of interest rate risk management, asset liability management, and more. Jim, I want to thank you for being here also today and joining us.
Thank you very much, Charlie. Great to be here.
With that, we have a great presentation coming up and a few housekeeping things first. Number one, if you do have any questions, please click on the Q&A button. I'll be monitoring the questions. We'll answer them during the presentation or later, if that makes sense. The webinar will also be recorded. If anyone would like a copy of it, please reach out to your MFA advisor and they'll get a copy of it to you. Also, we'll be on our YouTube site because we are YouTube stars and we're happy to have you see it there also. So with that, Heather, you can flip a page forward and I will hand it off to you.
Thank you, everybody, for joining us today. So just a little bit of a kind of a bullet point to let you know what today's discussion is going to look like. We are going to begin with recapping our ALM 101 webinar that was a little bit earlier this year, just an introduction to the concept of what ALM is. And now today we can kind of dive a little bit further into the next stage of how ALM impacts our balance sheet and what those drivers may look like. So today's focus point is going to be talking about our prepay speeds, our non-maturity deposit retention, our betas or rate sensitivity factors, how our repricing and replacement rates impact our movement of our sensitivity, and talking about spread and margin, which is extremely important, especially this time of year as we're working towards budgeting for next year and how we want to plan for the future. And Charlie had mentioned that our Q&A can continue throughout the webinar, so please be sure to post those questions as those arise. And when we have the opportunity to answer, we will definitely go through those as they come in. So just as a little bit of a recap of our ALM 101, Jim, can you just give us a little bit of background on some of the things that we did discuss during that webinar?
Absolutely, Heather. We defined what ALM is, very, very important. Right? I hope we know the answer to that question. Why do we run our ALM modeling reports? How do we perform the ALM analysis? And the two main parts of ALM analysis, net interest income or the reward part, and net economic value of equity, which is the risk part of ALM.
All very important concepts. And so as we want to look and understand what ALM is, I'm Italian. I talk with my hands. I like pictures, I like descriptions. And ALM, I always look at as a teeter-totter. It's that balance between our liabilities and our assets and how that sensitivity may pull that teeter-totter maybe one direction further than the other. So we're really balancing that mix and volume of our interest rate sensitivity between our non-maturity deposits, term deposits, and borrowings versus that asset side of the balance sheet, which is our lending, our investments, and those overnight funds and the impact of those as well. So Jim, why do we perform ALM analysis?
Well, we perform it quarterly and our balance sheet changes, right? Our strategy changes, loan demand, deposit behavior, what the membership wants us to do if we're a credit union and what our clients want us to do if we're a bank, quite frankly, right? So we're out there to serve our client base, our customer base. And in the backdrop of what goes on with our balance sheet, which constantly changes, the market changes, right? Yields change, opportunities change, shape of the yield curve. We're going to get some news from the FOMC tomorrow afternoon, so that's a part and parcel of why we would run ALM to see, how our balance sheet is performing in both the base case and the rate shocks that we're going to talk about.
So quarterly, meaning that our balance sheet doesn't stay flat for 12 months?
Well, that may be the regulatory metric for a lot of what we do, but no, our balance sheet is dynamic. Yeah.
Yep. And like you said, that's such the great part about keeping that constant look at what's things are happening and how fast things are moving, because we definitely are experiencing a lot of that right now. So we do have a few approaches, again, in how we perform our analysis.
Yes, indeed, we do. Um, we take a snapshot of your balance sheet, right? It's the current balance sheet as of the evaluation date. Um, we use the core regulatory model run is no growth. We're not assuming optimization. Replacement is a like kind, a hold flat balance sheet. We can incorporate growth assumptions as a what if analysis, and that's an important supplement to our ALM modeling, but it's not part of the original deliverable. That's something that we would use in the MFA Navigator.
Yeah, it's definitely a great tool, especially when we do run ALM. As we mentioned, this no growth, or we joked a bit about keeping that flat balance sheet for 12 months. That is our baseline. And that's one piece we'd like to look at. And we do encourage is starting with that baseline and running those what if scenarios. And this time of year is really a big focus point on that as we are planning for budgets and what things can impact our balance sheet and change over time. So as we get into our first kind of element of this, we have our net interest income, or NII.
Yes, total balance sheet income minus total balance sheet expense. So that's what netting out um, the funding that we have on the liability side, and what we can earn from that funding, right? It's loans and investments and a little bit of overnight cash, right, to keep some liquidity. But we see an example of our base case, right? This is the base net interest income over the next 12 months. This is 74,087,000. And then we do our rate shocks, and this we do gradual also, but this example is a rate shock, instantaneous, parallel, permanent rate shock, raising rates 100, 200, 300, 400 basis points and bringing them down also. And we see the repricing sensitivity because each element of the balance sheet reprices at a different magnitude. And then we see dollar change and also an expression as percent change from that base case. And then we have our policy limits to see if we're within the guidelines that our board has set for risk and net interest income.
We're not afraid of risk. We just want to make sure we have the right balance of risk, which is appropriate for our balance sheet. And that's really that nice part of having those policy and those guidelines to kind of understand what are we comfortable with and what's appropriate for that balance sheet. And when we look at our net economic value of equity, or NEV, it's kind of that same approach, but this is that snapshot in time of our balance sheet value as of the reporting cycle that we're looking. And if we were to take our balance sheet and value that in the market, what is that remaining equity left over, and how valuable is our balance sheet? So as we take our value of our assets and subtract the value of our liabilities, that remaining amount and the sensitivity that comes with it. And we're going to talk a lot today about some of those drivers that may change how that sensitivity can look. And back to that teeter-totter concept, when we look at NEV, and it's got a lot to do with what's going on today. And we're going to talk a lot about our expectations of where the Fed may be going and how that sensitivity and that income may be driven. But that idea that the longer assets that we have, the more sensitivity that we may hold. So looking at things as long as, say, a 30-year mortgage versus a midterm loan, something along the lines of an auto loan, or even our overnight funds that move right in lockstep with that market. So again, taking that long duration, it kind of pulls that teeter-totter down a little bit further as rates go up, because that incentive to refinance kind of goes away if rates are rising. You're not going to see a lot of refinancing of mortgages. You're going to hold on to those lower interest rates. So if the market's offering a higher rate, we're going to hold more sensitivity in the up environment. So you're going to have that kind of negative devaluation that's going to happen, versus if rates go down, then we have those a little bit higher rates. We're going to have a hold a little bit more value as those come due, because they take longer to reprice. And versus a midterm product that's going to be a little bit flatter in sensitivity because it's going to turn over faster, versus an overnight fund, which is going to move right in lockstep with that market and stay very flat. So as we go on to the liability side, the general concept here is that counterintuitive, or that flip. So in an up scenario, if you see these negative values and things are going down, We want that to happen in regards to our net economic value because that means that's less dollars being taken away from our assets, leaving us with a higher value at the end of the day. And then the opposite is true in that down scenario in some of these examples, showing that the value goes up, but that up is actually a devaluation. So it's just counterintuitive on that liability side, but that really gives you kind of a picture of how the two work together. So Jim, kind of a little bit of a summary of kind of what our ALM kind of entailed as we jump right into our 201 or a recap for our growth.
Absolutely. Yeah, we don't want to think of ALM and running our ALM reports as just a regulatory burden. It's a lot of valuable information that we can glean from our ALM reports. It allows us to be proactive, not reactive, right? And very, very important to see the impact of new products and actually pre-model new products. We can do that in the Navigator also, right? And simulate a new product and see what our risk is and what our reward is, and also allows us to take on some more risk if we feel that way, right? If we want to go into the market and have a little bit more duration mismatch on the balance sheet and stay ahead of potential problems.
Yeah. And it's really important right now, as we say, be proactive and not reactive. As many of us have experienced, examiners are very, very focused in interest rate risk world right now, especially as we're expecting the market to start to come downward a little bit and we start to see some of that squeeze. We want to make sure that we can leverage this information to really help make a proper decision. And examiners are very, very focused in these areas. And as we get into our next kind of section here of getting through, that assumption side of the model, this seems to be a hyper focus because we want to make sure that we are reflecting the actual activity that's happening to our balance sheet. And to do that, we want to look at the prepay speeds and how that impacts the cash flow of all of our assets and our liabilities and those that are impactful, looking at those retention terms on those non-maturities. This is a big change that we're starting to see as those deposits are moving in a different way than they have in recent years. We're going to talk a lot about that today. And then getting into how fast those rate sensitivities factors are impacted and how we should be pricing and how we do respond to the market. And then making sure those replacement rates are appropriate for some of the growth that we're going to see here, or opportunities that we may have. So the more accurate our assumptions are, the more accurate those results are, and we can really drive proper decision making when looking at our spread and our margin, really trying to maximize where we can be today. So Jim, looking at our prepay speeds is kind of the first of the three major moving pieces of assumptions, or that art side of ALM. Tell us a
Mhm.
little bit about what this may look like for us.
Okay, so CPR is how we measure prepayment speeds. There's a number of different ways to look at prepayment speeds, but we use CPR and this conditional prepayment rate, and it's also a constant prepayment rate. I like to use both of those terms because once established, that CPR that we're using is held constant for the life of the loan in the model, right? So we have different prepayment speeds we'll look at in just a moment and different rate shocks, but the assumption per the analysis is to hold that accelerated percent of prepayment, that's an annualized percent of prepayment that is above contractual, constant for the life of those cash flows, right? So about 90%, I think we did a study on this, right? 90% of the speed comes from refinancing, where rates could go down and you want to refinance your mortgage into a lower rate. Or if rates could stay the same and your house appreciation has been tremendous and you want to tap some equity, right? So there's a couple different ways you can have an irrational exercise, if you will, for that option where rates didn't move, but you want to, take some of that equity out for other opportunities. So very important to capture that behavior in our model. Now, the speeds that we use are updated every quarter. They are certainly market related, and we look at the coupon of your loans versus the current market opportunity that goes into that too for setting that base case prepayment. Not everybody's prepayment rates are going to be the same in the base case, right? Depends on your coupon that we're starting with, but they are updated for every analysis, but they are held constant in that analysis. That's the assumption that we're using.
And this is something that we're seeing a lot of activity or look at is making sure that if we do feel that our activity on our balance sheet may look different than a general market, you may have examiners asking you to do these prepay studies. You know,
Mhm.
what activity are we experiencing? Are these speeds appropriate for us? And things do change over time. So making sure we're having that balance of a little bit of market and maybe a little bit of activity that we're seeing on our balance sheet itself. And Jim, I love the visual of this. I think the pandemic gave us probably the prime example of the correlation between these two things, between rates and speeds. These visuals kind of give us a really nice picture here, huh?
Oh, they sure do. Yeah, this is an almost perfectly correlated inverse relationship, right? When when rates go up, prepayments come down. When rates go down, prepayments come up. A very, very good graph here. You see, December 2020, we had very, very high prepayment speeds, over 50%, as rates went down below 2% in our example here. And then as rates came back up in 2022, mid 2022, and for the rest of the year, prepayments plummeted. We had those mortgages. A lot of folks had sub 3% 30-year mortgages. They're not going to start prepaying those when we get to a rate environment about 6% or higher. Right, and that's what we're seeing here. So certainly, lower rates are faster speeds, higher rates are slower speeds, and we need to capture that in the ALM process.
Yeah, and you bring up a good point because I think we're going to see, and we continue to see some of these speeds and these values of these mortgages that were locked in at these record low rates really aren't going to go anywhere. So
Mhm.
there's an element that kind of protects us in in certain areas and may hold a little bit more risk in others in regards to how fast that turnover may look, depending on what our portfolio may look like. So again, as kind of that visual impact of the back and forth in a down scenario in Neve, as we see this impact in our risk position, we're going to see that as rates go down, that correlation of that speed going up. So if rates are dropping and we have some of those higher rate mortgages, say on our balance sheet at 8 and 9%, then incentive to refinance is really going to come up. So as that happens, you're going to see that turnover and we're going to lose those higher rates. They're going to go back on the books at a lower rate. So our cash flow is going to shorten, and that's really going to add to our risk here. We're going to actually lower that risk, going to be more positive. And in the up scenario, again, using that 30-year mortgage as a great example, because it is the most volatile, you're going to see those slower rates and that longer cash flow that may hold a higher risk because they're not going to hold as much value in comparison to that market equivalent. So you do see that direct movement in both directions. So sometimes we do get to see that as a big picture of our balance sheet itself. So Jim, the prepay speed kind of view here and some examples of what these speeds may look like for different asset classes. Again, looking at those mortgages, you're going to see a number of values that come out in the up scenarios where as rates go up, that incentive slows down. There's going to be a floor of some extent. And at McQueen, we really monitor and watch what Bloomberg is providing to us on what's an appropriate floor speed. And you're going to see some of those changes here, but here you can see that if we have a historically low rate pool where we're seeing this quite a bit with a lot of these that were booked during those low interest rates, that we are going to have very slow speeds in the up, but as rates go down, that starts to peak up. Jim, it looks like we kind of want to incorporate that floor. We're not going to have them go to zero because you are still going to see some activity there and some other classes that may be a bit faster.
Yes, absolutely, Heather. It looks like that base case is very, very close to the floor. That's indicative of very low coupon mortgages in this elevated rate environment that we had experienced right after that big trough in rates. 6%, what is that? Why would somebody in an up 400 turn in their mortgage? Well, it's the three Ds, right? You had death, you had divorce, you had default. So that, and also folks just want to move, right? You get this killer job and it's 1,000 miles away, and you're gonna turn in your low rate mortgage and move to that job. So there is prepayment activity regardless of the rate, but we do recognize that there's a floor, and geography also plays a role in that. Also, there are certain states that are um, more into that prepayment, out of the money prepayment activity. Certainly for market value conditions or opportunity conditions versus other states. So yeah, geography plays into it. The three Ds play into it certainly, and specific rates. Yeah.
Yep. Definitely a lot to consider when looking at these speeds.
Mhm.
So as a big picture of everything, we should have kind of a checklist as we start to review these to see if this is appropriate for us. So kind of go through some of the steps or the things that we should be asking ourselves when looking at prepayment speeds.
Oh, well, the first one is we could ask about any of the assumptions we're going to discuss today, and either the assumptions that we're not discussing. Reasonable and supportable, right? That's the two terms that we think about for our assumptions, and certainly that plays into prepayments, right? Is this appropriate for our balance sheet? Um, is our activity that we have on our balance sheet disparate from the general market? And again, that goes back to a certain extent, the geography, right? The sand states, if you will, Florida, California, typically have higher prepayments, all things being equal, than some other states. So there is some suitability depending on your geography. And also, if we're being asked to study our speeds by our examiners, right? If examiners want you to prove recent history is akin to where you are in your projection of prepayments, because the prepayments we showed are for projected cash flows going forward, right? Not historical, but we're looking at where we think prepayments are going to be. Certainly, that is a question to ask. Right?
And that's always the important part as we continue to monitor those through the year and sometimes incorporate some market speeds to account for some of those fluctuations or changes that have happened through the year versus what had happened in the year past.
Mhm.
So as we finish prepay speeds, we're moving on to the next section of our assumptions of those three major moving pieces. And now we're really getting into these non-maturity deposit retentions or NMDs. So Jim, tell us a little bit about some of the types of products that we're talking about in this part of the analysis.
Well, non-maturity deposits are well, by definition, are deposits without maturities. Should never do that. But yeah, our checking accounts, our share accounts, IRAs, money markets, accounts that are not contractually committed to our institution, right? We think of borrowings, they have a maturity, and we think about CDs on the liability side of our balance sheet. The preponderance of deposits very often are non-maturity deposits, right? So deciphering that behavior is very, very important. There's a lot of value to those deposits. They're cheaper, if you will, lower interest rate than term deposits. But yeah, it's anything on the liability side of our balance sheet that does not have a contractual maturity.
So when looking at these, it looks like we've had some interesting trends that have gone over the last few years, and it looks like things have changed a little bit than what we were experiencing over just these recent years. So it looks like we've kind of pivoted a little bit here.
Oh, we sure did. So well, what we're seeing now is deposits are stabilizing, but we came out of a pretty rare situation where deposits went down, balances were retrenching from 2022 through 2023. We had a more stabilization, if you will, in 2024, and 2025 is a little bit growth there. So as deposits come back into our institution, we have the opportunity to lower the rates on our CDs typically, right? Because those are the higher rate deposits. There's some more room to move those down, and we can really take the lead from the market. Right? There's a lot of treasury yields that are down about 100 basis points from where they were. So our CD rates should be coming down, and we really take the lead from deposit stability. Right? If our balances are growing back in, we can certainly move those rates a little bit lower.
And really looking at this, we have got some interesting activity that's been happening. And for when we look at these deposits, we really want to understand what is our expectation for the future? Because in the absence of these deposits, as Jim mentioned, we have to go out in the market into inherently more expensive types of deposits to help fund that asset side of the balance sheet. So when we look at the terms and the values of these products, we want to understand what is the activity based off of what the market's giving us, and how does that tie to what that retention should look like, how we're going to price these deposits. And this is a great kind of view of the different types having different activity depending on what's going on. So this kind of focus point right here is looking at how that retention is going to change over time for sticky, what we refer to as sticky deposits or more core deposits, such as checking accounts and savings accounts, versus more rate shopper type of products, such as money market. And we can see that we want to make sure that when we study these and we determine what duration we want to put on and how long we think we're going to retain them, that could vary over time. And certain products may be more driven to change that activity than others. And the money market's a great example of this. And one statement here that we'd like to always kind of rely on is staying conservative because we know things change over time. We don't want to be a little bit overzealous and claim that, oh, over time we've had 95% retention on money markets. Well, as you can see in 22, they stayed around for a long period of time. And as we go into 23, they started to slow down. And that activity continued to go in that same direction where that retention started to reduce. And a lot of this was driven because of the changes of interest rates, and a money market product is more that rate shopper type of product. So if we were looking at that analysis, and historically we had used, say, 96 months, then we went up to 108, then to 120. Well, was that appropriate to raise that fast? We see the trend of this retention is actually reducing because of the type of product it is. And now, as we did the most recent study, we had found it dropped again. So now what we end up having to do is actually reel that duration back in from 10 years and dropping it back down. As you can see, that calculated expectation is only 111 months. So this is something to consider when we look at these product types. Know the type of that you're looking for, and know that that activity is probably going to change depending on what the market is giving us. So as we come into this page, you can really see what some of this may look like, and not just based off of the number of accounts that we may have at our institution, but the volume of dollars that go hand in hand with it. So again, if we look at these sticky deposits or non-maturity or non-interest bearing deposits or checking accounts and savings accounts versus a rate shopper, which is more of that money market, you can see some interesting activity. And historically, when we ran a core deposit study, we only looked at the number of accounts. And during the pandemic, we identified that the volume of dollars that were coming in and leaving was a really important view to look at as well. So in our studies, we've actually incorporated both to kind of drive what some of this retention terms should look like. So when we look at these more sticky deposits, we may have less accounts. And as you can see with the non-interest bearing, we only had a retention of, say, 87%. But when you look at the number of dollars that are in those accounts, that retention was significantly higher versus the total opposite that you see with money markets, where there may be much more accounts. They stay around for a long period of time, but the actual dollar amount is not there because they're shopping, they're exiting those funds, and they're reinvesting somewhere else that they're going to earn a higher interest rate. This is important to think about right now because we have some opportunities because deposits have stabilized. And since they have stabilized, we can reduce our expense. And this is going to be important as an opportunity if rates do start to reduce, or we're going to see that asset side start to come down. Can we reduce that expense on the liability side to help offset some of that squeeze to our margin? And this is where some of that activity can really pinpoint exactly what's going on with our balance sheet and where those opportunities are to be able to price appropriately. So Jim, if we had an equivalent in the market of these other types of deposits, is there some value that comes with the need value that goes hand in hand with the types of deposits?
Oh, yes, Heather. There sure is. When we look at a core deposit study, as you just went over, and the extension that we have for these, the stickiness of deposits, that manifests in our ALM analysis as reduced risk as rates go higher, right? Because we've got more sympathetic depreciation with those liabilities as in a rising rate environment. As rates go lower, the exact opposite effect takes place, but it mitigates the risk, right? We have long dated asset cash flows in the example here. When we extend the liabilities, we have less negative outcome as rates go higher. We have less positive outcome as rates go lower because we do have that appreciation in those deposits, dollar appreciation as rates come down. But it's akin to a sailboat, right? The sail is our asset side of the balance sheet. The liability side is the keel, right? And we can't have a big high sail without a big keel, or our boat is going to tip over, right? So the long dated liabilities support our lending activity in that 30-year mortgage area, our long dated investments, yield rich, yield curve opportunity. Yeah.
And this next kind of really shows that difference in funding sources, whether if in the absence of those deposits, we need to go elsewhere, such as borrowings, that inherently just cost a lot more.
Yeah. This chart shows the blue line core deposits have higher duration than the funding source, right? Typically, an advance or something, right? Some fixed rate, fixed maturity um, funding. So we see as rates rise that core deposit is giving us more of that sympathetic decrease, right? We're at 90 cents on the dollar in the up 300 versus 94 cents in the dollar for that shorter funding source. As rates go lower, we have more of that appreciation in the core deposit that does appreciate more than that funding source, but our assets would typically be out appreciating what our core deposit is, right? And we would have more benefit in the base case because those core deposits are well below market, right? So it'll give us a big base case premium in NEV, which gets eroded a little bit in the declining rate scenarios, but is enhanced as rates rise.
Definitely an important step to make sure we've valued and have the proper retention duration on those deposits.
Mhm.
Really stabilizes what that need can look like and that sensitivity, especially if we have a little bit longer durations on that balance sheet. We're a little bit more sensitive in certain directions. So as we get into our last major moving piece of the art side of ALM, we're looking at our betas or rate sensitivity factors. It seems that there's a kind of a lot of moving pieces that go into this and how those impact from one area of the balance sheet to another.
Absolutely. We mentioned before that there's different interest rate risk for each balance sheet element, right? We look at everything as a whole, right? But each line item has a different sensitivity for interest rate movement and also for repricing opportunity, right? So the betas, it's an assumption we have to make in our model when we do our rate shocks, up 100, 200, 300, and conversely are down 100, 200, 300. The factors we need to consider, what is the product that we're assigning these betas to? Is it fixed rate versus variable rate? Variable rate, we're going to use the entire rate shock. A fixed rate, we're going to really mimic the behavior of the yield curve, right? We know longer dated points on the yield curve do not move as much in a yield standpoint as shorter dated points, right? There's less yield volatility out the curve than there is in the very front end of the curve, but there's more price sensitivity, right? The dollar value of those basis points is greater. And then we have to take into account caps and floors, periodic caps, lifetime caps, and then floors that take place. So they are going to affect our betas throughout the analysis, right? Throughout the rate shock scenarios.
And I like that you bring that up because I think this is a major moving piece for most balance sheets of having a mix of both fixed rate products and variable rate products. And when we go to run our income, we really need to understand what activity is happening in each of these loans because that can vary so significantly from one to another. So one example that you see here is our mortgage variable. So we know that over time, we may have a lifetime cap of say 6%, and rates can increase and we can raise that rate by 6% over the duration of that item. Well, when we do our study in ALM, we are looking at 1 year forward. And as we do that 1 year forward, this is where those periodics come into play. So despite having a lifetime of 6%, we know in the next 12 months, no matter what the Fed decides to do, we can only raise rates by, say, 2%. And if that's the case, we want to make sure we model that appropriately. We don't want to claim that we are going to be able to increase 3 and 4% on this loan as rates go up 3 and 4% as well. We actually have to stop it out once it increases only by 2 and hold it steady for the rest of that income sim. And so as this occurs, the same thing may happen as rates go down. Well, say on this example, you have a lifetime floor of 2.76%. You can see once we get to a rate shock of 4%, reduction, we can only reduce by, say, a portion of what the market's doing, not the entire 100 basis points. So we are going to floor that out and capture that. And this is an important element when modeling our income and modeling our value, is capturing these activities within each of these products. And as we look at fixed rate loans, they're going to move a little bit slower. We're not going to expect they're going to move in lockstep with the market. So we may have some adjustments here. And again, this may drive based off of how you respond. And that can be driven off of the region of the country you are, the peers that you have around you. You may price your auto loans a little bit differently than you may your mortgage loans, depending on what activity you're expecting to see. So making sure you're modeling and capturing those appropriately. And a great example here is showing that a fixed rate auto loan would only move about 75% of what the market is doing. So as we get to the investment side, you can see a similar activity of, say, our overnight funds. That's going to move right in lockstep every 100 basis points in each direction, versus a fixed rate CD that is going to match that activity of a deposit and maybe only move about 75% of the market. So we did see a little bit faster activity during the pandemic, but all in all, we generally see these kind of stabilize a little bit closer to what you would see on that asset side of the balance sheet. So now when we look at our deposit side, we are seeing some consistent patterns happen when we look at the cost of our funds. So when we look at core deposits, or more of those sticky deposits, such as checking accounts and savings accounts, those are inherently less expensive. So one area that we are seeing is how rates are flooring in a down rate environment. So let's say tomorrow the Fed does start to reduce rates. Are we going to be able to reduce our cost of funds in the process? And some of these rates are low enough where there's really not much room to go. So what's going to happen is, as you start to see your income simulation, you're going to see that floor happen on those deposits, but those asset sides, it's going to start to reduce a little bit faster than what we can on the cost of our funds. This is where we may see some of that squeeze. So we want to take advantage of how we can price some of these deposits, knowing we may not have liquidity concerns and we may not have to price these higher to bring those deposits in the door. And these money markets, we can really start to reduce these costs. So is 40% of the market appropriate? Can we price these differently in these down scenarios than the up scenarios? And those betas actually may look different. I have seen plenty of balance sheets that have a dynamic approach where they're going to be a little bit lagged to increase those rates, but as rates come down, they're going to reduce them much faster. This is the glorious part about this aspect. When we look at these betas, we have the control to implement what our activity is actually going to look like. Now, when we look at our term deposits, this is another opportunity right now to try to reduce some of these rates and really start to improve our spread where we can. So just keep an eye on some of these flooring of rates, and just know that the interest rate risk in that down scenario may start to squeeze a little bit because of our low cost of funds. And if you have some opportunity to reduce those costs, this is the time to start to do that. So as we look at our repricing and we go into our replacement rates, one area that we really want to focus on is making sure that the new rates that we're putting on the books are appropriate for us. So what rate will we be booking over those next 12 months? Do we think that as rates start to come down, we're going to match the market? Or do we think we need to keep those a little higher to keep them coming in the door for that liability side, or on that asset side of the balance sheet? How fast do we need to start to reduce some of these rates? And we want to make sure that we're priced appropriately for the market. What are our competitors doing? Are we priced appropriately for this market? And are we priced appropriately for that cost of funds? We want to make sure that we're not adding too much expense if we can't get a good enough spread on the lending side. So there's definitely a lot that we want to bring into consideration, and to be able to look between our yields and the coupons of what that may look like. And another area is making sure that we're monitoring any participations or dealer fees that may come into our participation pools or indirect lending. We know we have some spreads that we're paying back to them, making sure those are priced appropriately based off of what's going on in the market today. So we have some great tools on our Navigator helping being able to price our balance sheet. And here's just a quick example of some of the things to take into consideration when you are looking at your repricing. We want to look at what that risk-free treasury yield may look like and being able to implement some spreads here to make sure that that net ROA or ROE is where we want it to be. So starting with that risk-free treasury rate. We're going to bring in some of our allowance from CECL. And this is the great tool with CECL as well, is making sure that we're implementing what that risk may look like from one asset class to another. That could vary depending on if you're looking at an auto loan or a mortgage. Your risk position or your loss ratios that go hand in hand with that can vary. So making sure we're implementing some of those values. And then making sure we're taking into consideration how we're pricing and what kind of credit we're bringing in and what that risk may look like attributed to that credit level. If we have any additional servicing costs, bringing those into play. And then at the end here, making sure that what that return we're looking for is going to be in that range. And this really helps us be able to price. And we have some fantastic tools right on the Navigator that can help you do that build up process. And looking at that difference between some of our booked rate versus replacement rates, we have some asset classes that are very fairly stable right now and others that are starting to retract a little bit. So these are some of the things to take into consideration and look at. And as we go into our spread and margin, this is where everything kind of comes together. Looking historically of where we've been and where we can go in the future here, you can see some of the trends of our asset yields have continued to rise in some areas and kind of stabilize. Our overnight funds have come down just a little bit. And then looking at our cost of funds, we really have some great opportunities right now of that turnover of term deposits. We can start to price those significantly lower and really help some of that reduction we may start to see on that asset side of the balance sheet, really focusing on where we can be in regards to spread and margin and profitability. So these are some of the tools that we want to look at when budgeting for next year. We do highly encourage to utilize things such as our online simulator. Let's look at that expectation in our budget. Are we focusing on certain product types that we want to grow? What is that cost that we could have that goes hand in hand with it, or the yields that we can earn on those, and really start to see what that long-term impact could look like. As we are expecting rates to come down slightly, a lot of things can change for us. So making sure that we have priced and structured these rates that we're offering appropriately for where we want to be in the future, knowing things are starting to retract just a bit. We do have some nice kind of view here on some of those future projections. As of now, or as of June, we were seeing that we were still turning over some higher rates, especially on those investment turnovers. We are seeing some larger opportunities. Some of the lending, we're seeing that as well. And that liability costs we're seeing start to come down a little bit. So again, taking advantage of where those opportunities are and continuing to hold a nice, strong margin position. So when we look at the assumption side or the art side of ALM, this is the areas that we want to make sure that those factors in the market are being captured appropriately. So we know how to budget, we know what we're expecting and how those changes to income is going to look. What does our value look like in this scenario? Are we taking on the most appropriate type of risk based off of where we are? So making sure the assumptions that are in the model are appropriate for us really gives us accurate assumptions and accurate results to make that crystal ball for the future and for that planning more appropriate for what we're expecting to see. We want to stay conservative, but we also want to be realistic. We don't want to have, say, a 75% response on a money market when in reality, we don't really need to bring those funds in as much, and we can make those a narrower beta as we are expecting to price those products. So it's something to look at and compare, making sure the retention terms on these deposits are appropriate for the activity that we see, and making sure that we are pricing all of our moving parts appropriately as well, and really give us a good position to be in going for the future.
Yeah, well said, Heather.
Thanks, Jim. All right. So Charlie, did we have any questions that arose during that?
Oh, first of all, thank you both. Great commentary, great information, and eventually my camera will turn on perfectly there. So, thank you both, Jim and Heather. Couple questions came in. I'm going to start off with a bit of a hard one. Assumptions. How often should I review my assumptions?
Well, I'll take that one as long as my internet still works in.
Yes.
Minor
Um,
minor
Welcome back,
details.
Jim. Please take it.
Thank you. Yeah. Well, that was an odyssey there. Um, well, we need reasonableness and they need to be supportable, Charlie, right? So the answer could be in a very benign market time with a very benign balance sheet movement annually, right? Or we need to assess our assumptions as often as quarterly when we run our model, depending on what's happening with the yield curve, what's happening with our balance sheet, our funding, any of that. So we want to keep our assumptions relevant, and sometimes that necessitates a more frequent review of these assumptions, but certainly annually, if not more often.
Yeah, but I think that's a really good answer, Jim. Annually is a minimum, and if things go haywire, maybe faster. So,
Mhm.
another question came in: is will the slides be circulated? The answer is absolutely yes. We'll be sending those around, but please reach out to your advisor, and they will get them to you. So we're not going to automatically send them. Please reach out to your advisor. All right, next. Early on, there was a question, and frankly, I missed it. Let's just be honest about the deposits. Heather, you said changing deposits are going to be changing differently this year from the past, and maybe you could expand on that a little bit. There was someone was trying to look for a little more clarity.
Absolutely. So again, kind of referring back to the concept of sticky deposits versus rate shoppers. This is where we want to look at the type of deposits we're expecting that are going to stick around versus the other deposits where those dollars are going to leave the institution and go somewhere else for a higher rate. We generally price our deposits in a manner which brings them in the door and keeps them around to properly fund our asset side of the balance sheet between our lending and our investments. So what we want to do is make sure that if we have opportunities to bring down some of those interest rates, if we have a proper amount of liquidity, we can start to bring some of those rates down. And as that happens, you would expect to see some of the more rate shopper type of products to leave the institution. And on the other side of that, more the checking account, savings accounts, or those sticky deposits, you're generally going to find that even when you reduce those yields, that those deposits probably aren't going to leave nearly as quickly. So those are the things that we want to take into consideration on how we price our deposits and knowing the activity that we would expect to see based off of the decisions that we make.
Wonderful, thank you, Heather. That really helped. Again, if you have any questions, please hit the Q&A button. We have a couple more to go through. Another one that came in, Jim, for you. Um, in the investment side of things, the question was, are callable bonds a good or bad thing to buy in a downward interest rate environment?
Oh, well, I wish all my questions were this easy, Charlie. I don't like callable bonds in a declining rate environment, and I don't like callable bonds in a rising rate environment for two different reasons. We saw the play with callables back in the trough, right, with the rates. You get a 5-year callable for about 1% versus the 5-year note, which is about 50 basis points, which worked out great. It was a 3-year no call, 5-year no call, 3-month. But when rates started going higher, all of a sudden that 3-month paper with the rolling becomes a 5-year piece of paper at a very undesirable rate, right? So we don't like callables when rates are going to go markedly higher, and because of the extension risk, right? And we don't like being called out of a nice coupon to have to reinvest in a much lower coupon. So anytime the market is perceived to have moved into it, right? We don't want to be short that option.
Great. Thank you very much, Jim. That kind of was a layup one for you in hindsight. So I'll try to go for tougher ones here. But this one, actually, I'll throw it out there to both of you. Interesting question. On average, how much do interest rates need to fall before liability costs floor out? So rephrase the question as I'm reading it here. Basically, on average, how far does the Fed need to reduce the Fed funds rate before deposits are hit their floor? On average, obviously. Don't fight over it now.
I would say at this point, seeing where for a non-maturity deposit side, not very far. We're seeing those costs fairly low, but we still have a lot of room in that term deposit side. So I would say it would have to be at least 100 basis points before you're starting to see that floor start to occur, as we're seeing that pricing really start to retract right now.
All right, thank you, Heather. Jim, any comments you want to add there?
Well, yeah, non-maturity deposits typically are pretty close to the floor, more or less, certainly much more so than term deposits right now. But I think that prior interest rate cycle we saw, we got very, very close to flooring non-maturity deposits, right? So the answer is, Fed funds sub 1% for yeah, pretty much everything on the balance sheet. In this environment here, we can experience positive effects with regard to liability cost right now. And as rates go a little bit lower, we would continue those effects, and then certainly the term deposits, if not a little bit in the core deposits. But yeah, well, we can certainly foresee situations where the preponderance of our liabilities would floor. We pretty much came out of that rate environment.
Yep. Nope, I appreciate that. Well, thank you, Jim. I appreciate that answer. Heather, thank you also for your answer there. I want to thank all of you for attending today. That's the last of our questions. But thank you very much for the two of you for your insight. And again, reach out to your MFA advisor. We're happy to share a copy of this. And our next webinar is coming up on the next slide. There we go. I forgot the date. So thank you. Our EBPA and CDA portfolio webinar on September 30th. Get that right at quarter end. How awesome is that? From 2 to 3 p.m. We're going to be talking about charitable donation accounts, some great examples of some friends of ours that are having great success with their charitable donation accounts, and some employee benefit pre-funding account information. With that, thank you all for attending, and we appreciate all of you, appreciate the relationship, and have an absolute wonderful remaining month of September. Thanks much.